Welcome to Iron Financial. This is the only place where we really stress test the market, all to help you forge a stronger, more resilient portfolio. I'm your lead analyst. So tonight, we are putting Braze, that's ticker BRZE, directly under the microscope. After their latest earnings report dropped, the stock absolutely rocketed up in after-hours trading. But when you look closely, the numbers tell a dangerously contradictory story. We're here to cut through all that market weakness and find out what's really going on. Okay, let's just get right into it. On the surface, the structure here looks pretty solid. You can't deny it. Revenue came in hot, really hot. We're talking over $205 million. That's a 28% jump year over year, and it absolutely crushed what Wall Street was expecting. Now, that's the kind of number that gets the bulls really excited, and you can see why the stock reacted the way it did initially. But hold on. Let's not get ahead of ourselves here. While everybody was popping the champagne over that big revenue beat, the foundation of the house was actually cracking. Look at this. They posted an adjusted earnings per share of just 10 cents. The consensus on the street, 14 cents. That is not a small miss, folks. That's a nearly 28% negative surprise. So the big question, the one we're here to investigate, is how. How can a company look so strong on the top line and so incredibly weak on the bottom? That's a massive red flag. Exactly. And that is the core tension, the fundamental contradiction that we are going to tear apart tonight. So to do that, we've structured this entire analysis into 6 distinct parts. First, we're going to dig right into that headline contradiction. Then we'll take a close look at how they're forging that top line, what's really driving that impressive growth. After that, we're going to grab our tools and start probing for the cracks in the foundation, focusing squarely on profitability. From there, we'll analyze the so-called AI support beam they're touting as their key to future growth. Then we'll review the actual blueprint for their next fiscal year, their guidance. And finally, after weighing all the evidence, we'll deliver the iron verdict. Let's get to it. So this is it. This is the crucial point right here. This isn't just about one good number and one bad number sitting next to each other on a page. No, this is about the structural integrity of the entire company, of the entire investment thesis. When you see revenue surging while profit falls off a cliff, it has to force you to ask some really hard questions. Is this growth that we're seeing actually sustainable, or is it just being bought at way too high a price? Is the company trying to build a skyscraper on a foundation made of sand? That's what we need to figure out. All right, now let's look at the official story, the narrative coming directly from management. The CEO, Bill Magnuson, he came out and called it an exceptional Q4. And look at what he's pointing to: accelerating organic growth. For a company this size, that's a really powerful signal to the market. He's essentially telling investors that the core engine of the business is firing on all cylinders. And, more importantly, it's actually picking up speed. That's the story he's selling. Exceptional? That's a really strong word, isn't it? An exceptional quarter where you miss your profit target by almost 30%? To me, that feels a little bit like they're pointing at the shiny new paint job on the house, really hoping that nobody looks down and notices the massive water damage spreading across the basement floor. So let's see if that top-line growth is really as solid as they claim it is. All right, let's do exactly that. We're now moving to the first part of our deep analysis, forging the top line. And I want to be clear here, I'm going to lay out the heavy steel beams of the bull case, because no matter how you slice it, you cannot deny that these growth metrics are impressive. This is the raw power, the brute strength that caught the market's attention, and it absolutely deserves a very close look. It all starts right here, a 28% year-over-year revenue growth for the quarter. And let's be real, this isn't some tiny startup posting big percentage gains off a low base. We're talking about a company that's on track to blow past $800 million in annual recurring revenue. To actually accelerate growth at this kind of scale, well, that's a serious feat of strength. Make no mistake, this is the primary pillar holding up the stock right now. Okay, 28% is strong, I'll give you that. But where's it coming from? Is this just momentum carrying over from last year? Is it just old business? That's the key question. And this next number gives us the answer. Quarterly bookings were up over 50% year over year. Now, for anyone watching, bookings are a forward-looking indicator. This isn't about what happened in the past. This tells us the customer demand is not just strong, it's accelerating. And I mean significantly. Companies are out there signing bigger deals, longer-term contracts, which suggests a whole lot of confidence in Braze's platform for the long haul. And this table right here, it really illustrates the breadth of their outperformance. It wasn't just that one headline revenue number they beat. Look at this. Current remaining performance obligations, or RPO, that's basically just contracted future revenue that's already in the bag, came in at a massive $642 million, easily beating estimates. Then you have dollar-based net retention, which is a fancy way of measuring how much your existing customers are expanding their spending. It inflected positively, ticking up to 109%, also beating what the street expected. So they aren't just growing, they are systematically outmuscling expectations across all the key forward-looking metrics. But the real heavy lifting, the place where the true strength lies, is happening in the enterprise segment. This chart is so important. It shows a 35% year-over-year explosion in the number of customers paying them over $500,000 a year. Think about that. These large, sticky customers now make up 64% of their total annual recurring revenue. This isn't just growth for growth's sake. This is high-quality growth. They are building a fortress, and these large, stable enterprise clients are the giant cornerstones. This right here, this is the foundation that the bulls believe can support the entire structure for years to come. A strong facade is one thing, but it can hide a multitude of sins, can it? Now it's time to take a hammer to this whole structure and see if it actually holds up under pressure. Let's move on to the cracks in the foundation. Because all of that top-line strength, all that flashy growth, it means absolutely nothing if the company is bleeding from the bottom line. It is time to stress test the profitability. Let's just start with the single, ugliest number in this entire report, a negative 28.57% earnings per share surprise. The market expected 14 cents of profit. Braze delivered 10. This isn't a small crack, this is a significant fracture in the foundation. It screams that the cost of achieving that admittedly impressive revenue growth is much, much higher than anyone anticipated. And right here, this is where the bull argument really starts to crumble. And here's exactly why that EPS miss is so concerning. Just look at the erosion in their gross margin. It compressed all the way from nearly 70% last year down to 67.2% this year. Now, this is not a rounding error. What this means in plain English is that for every single dollar of revenue they bring in, less of it is actually dropping down to the bottom line as profit. This calls into question the very quality of their growth. You have to ask, are they sacrificing profitable, durable growth just to chase those flashy headline numbers? This trend right here suggests they might be. Now, to be fair, the company does have an explanation for this. Management stated on their earnings call that this margin compression was, and I'm quoting, primarily driven by higher premium messaging volumes and hosting costs. So the argument is, as their customers use the platform more and more intensively, especially with certain high-cost messaging channels, the direct costs tied to that revenue go up. They see it as an operational headwind, yes, but also as a direct function of higher usage and customer success. And there's another really crucial piece of context here that makes that EPS miss a lot more complicated. Their non-GAAP net income, which is their earnings number with certain one-time or non-cash expenses stripped out to give you a clearer picture of core profitability, it was negatively impacted by a $5 million purchase accounting adjustment. Now stay with me here. This was a non-cash item. It's related to a deferred tax liability from their acquisition of a company called OfferFit. The key thing is, if you exclude this one-time non-cash adjustment, their non-GAAP EPS would have actually been 15 cents, and that would have beaten the 14-cent estimate. I see the argument, I do. But you can't just wave a magic wand and make a $5 million charge disappear into thin air. I'm sorry, yes, it's a non-cash accounting item, I get it, but it's still there on the books. It complicates the picture. It makes that clean, we actually beat narrative a whole lot messier, doesn't it? At the absolute best, it just muddies the water on profitability. And at worst, it's a sign that the underlying cost structure of this company is still under serious pressure, even if you try to adjust for the one-offs. The foundation is shaky, period. Fair enough, the profitability picture is complex, no doubt about it. But the investment story for any growth company isn't just about the here and now, it's always about the future. And Braze is making a very loud argument that they are in the process of installing a massive new support beam that will reinforce the entire structure. And that is artificial intelligence. So let's examine if this AI story has real structural integrity or if it's just, decorative. Okay, so let's look at the actual tools they're building. They've rolled out a whole suite of AI products. We've got the Braze AI Agent Console, the Braze AI Operator, and the big one, the Braze AI Decisioning Studio, which came from that OfferFit acquisition we just talked about. This is not just some marketing gimmick where they slap AI on everything. This is a dedicated, real product suite designed to be the engine for their next big wave of growth. The company believes this will make their platform stickier, way more powerful for their clients, and ultimately a lot more profitable for them. And you can see the CEO is doubling down hard on this narrative. Magnuson claims that the world's largest and most sophisticated brands are choosing Braze as a foundational partner for their AI transformation. Now, the positioning here is absolutely critical. They don't want to be seen as just another marketing tool. They want to be viewed as essential infrastructure in the age of AI. They're selling a vision of the future where their platform is the central nervous system for all AI-driven customer communication for these massive companies. You know, that is a fantastic story. It's a powerful narrative, and it sounds great on an earnings call. But here at Iron Financial, we care about what's real today. Is this AI hype actually generating cold, hard cash, or is it just a convenient story to distract us from the margin compression we were just looking at? Forget the story. Show me the numbers. Show me how this supposedly transformational AI is actually paying the bills right now. All right, you want numbers? Here's the first concrete number we have. The Braze AI Decisioning Studio contributed $5.7 million in revenue this quarter. This is it. This is the first tangible piece of evidence of their ability to actually monetize this new AI stack. $5.7 million. Out of a $205 million quarter, that's less than 3% of their total revenue. I'm sorry, but that is a rounding error. That is not a foundational support being holding up the company. That is a decorative piece of trim you barely notice. Right now, the hype-to-revenue ratio on this AI story is completely, and I mean completely, out of whack. Look, it's a starting point, and it's growing fast. But you're right, we need to look forward. And that brings us to the company's guidance, their official blueprint for construction in the year ahead. This is where management lays out their real expectations, and it's where we can see if the numbers truly support the narrative of future strength, or if it's more of the same. All right, let's break down this blueprint. For the full fiscal year 2027, they're guiding for revenue somewhere between $884 and $889 million. Now, the crucial point here is that this is significantly above the Wall Street consensus estimate of $857 million. That is a powerful signal of confidence for management that their top-line momentum is going to continue. But, and this is a big but, look at the other side of the ledger. Their adjusted EPS guidance is for 61 to 65 cents. You know what the analyst estimate was? 63 cents. So their profit guidance is just meh, it's in line. So after a huge miss this quarter, they're guiding to just meet expectations next year. This blueprint tells me one thing very clearly. The margin pressures we saw this quarter are not going away. They fully expect to keep spending heavily to get that revenue growth. The profitability problem persists. But management is putting their money where their mouth is. They just announced a brand new $100 million share repurchase program, and it includes a $50 million accelerated buyback. This is a classic sign of strength. It signals that the board, the executive team, they all believe their stock is fundamentally undervalued, and they have deep conviction in their long-term plan. They are literally investing in themselves. Or it's just financial engineering. Let's call it what it could be. When your profitability is under the microscope, a big buyback can be a very convenient way to prop up your earnings per share number and signal confidence you might not actually have. I mean, it could be seen as an attempt to put a floor under the stock price rather than a pure signal of fundamental business strength. It's another one of those moves that looks great on the surface, but you really have to question the motivation behind it. All right, we've laid out the heavy steel beams of the growth story, and we've taken a hammer to the cracks in the foundation. We've looked at the current numbers, and we've analyzed the future blueprint. So it's time to weigh all of the evidence, the good and the bad. It's time for the iron verdict. So let's put it all on the table, side by side. The bull case is built on a really solid frame. You have accelerating organic revenue growth, you have that incredible 50% plus bookings growth showing intense demand, and you have that clear, undeniable shift towards larger, more stable enterprise customers. On top of all that, the forward-looking AI roadmap provides a very compelling blueprint for future innovation. The bear case, however, points to some very serious foundational issues that you just can't ignore. That significant EPS miss is a major problem. The consistent gross margin compression really calls into question the quality of all that growth, and the AI story, for all the talk and all the hype, is currently contributing a negligible amount to actual revenue. The whole structure could be top-heavy and, frankly, unstable. So what is the final verdict? Is Braze forging real growth, or are they faking strength? After stress testing every number, our iron verdict is this: opportunity. But, and this is a big but, it is a calculated one. The cracks in profitability are absolutely real and they cannot be ignored. The margin compression is a significant headwind that could persist. However, The sheer force of the top-line acceleration, driven by that powerful enterprise demand and what appears to be a clear lead in AI innovation, it provides a level of structural integrity that is just hard to bet against. This is not a finished, polished skyscraper. It is very much a construction site. Investing in Braze today is a bet that the AI support beam they are installing will more than compensate for the current foundational weaknesses. It requires an investor who is willing to tolerate the noise, the dust, and the risk of ongoing construction. But the blueprint, if they can execute, points toward a much stronger, more valuable structure in the future. That's the hard truth. We'll see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.